Welcome to the Day Trading for Beginners podcast. This is season 2, episode 9. And in this episode, I'm going to go into more detail about the strategy that I am learning. So in the previous podcast, I spoke about the differences between day trading, swing trading, and position trading. And I mentioned that there are 2 strategies that I am focusing on in, this season 2 of this podcast. And, at this stage of my journey, one is more of a day trading type of strategy. And the other one, which I have been leaning more towards, is more of a swing and position trading strategy. So you can use this strategy for day trading. However, the person that I'm learning from uses more of a high time frame types of charts, so weekly charts, monthly charts, and it's much more of a position or a swing trading type of strategy. That being said, you can use it for day trading. And again, this podcast is about day trading, and that's the journey that I'm on. I'm trying to become a day trader, but it doesn't mean that, I might find a strategy that kind of works better for me. And that might be a swing trading strategy, or, it might be some other type of strategy. And you might get into that stage as well, where, you think you want to do day trading but you come across a strategy that, is trading, but it might not be, specifically day trading. So that's what we want to cover in this podcast. Basically, I just want to run down and give an explanation of how this strategy works. So again, I'm Tyler Stokes from StokesTrade.com. And again, I'm on this journey to become a full-time day trader. And what's great about season 2 is that I'm actually studying a strategy. So below in the show notes, you can actually find a video and a write-up to what I'm going to cover in this podcast if you want some more detail about it. But you can also download my 6-month blueprint if you are a pure beginner. And what's great about the blueprint is it helps you get started from scratch and what you should do in your first 6 months. But then you're going to come to a stage where, you know the basics, you know how to buy and sell stocks, technical analysis. But then you want to look at the charts and you want to figure out, what are you supposed to do? And that's where strategy comes in. And, over the last several weeks, I've been studying this market symmetry strategy, and I can actually, look at charts now and I kind of know what to do. And it's a great feeling because I can actually, look at my computer, and, consider working for the day and actually look at charts and actually potentially make some trades. And I've been doing that in my paper trading account. So that's a good feeling. And it's something you're not going to get until you go out and study a strategy. And again, in the show notes, I'll have all the links to more specifics about this strategy. Full disclosure, I am learning the strategy from, a quote unquote professional trader. So I'll have his links below. He's called The Great Matsby, and he has a Patreon that I am a member of. So I've talked about this strategy a little bit before, and the edge for this strategy is about recognizing market symmetry. So being able to sort of look at the chart of any stock, sort of tell the story of that stock and recognize the symmetry of the market. So, markets tend to move in patterns, repeating themselves over and over. And once you learn to identify these patterns, you can sort of let the charts do what they are supposed to do without getting emotionally involved in your trades. Obviously, that's easier said than done. That's the goal. But the more you study it, the more you practice, this method, this strategy seems to really go with a symmetry that I've noticed just from doing it for, a few months now, that, these charts do follow a symmetry, and it's kind of cool to see. So the more you study, the more you apply this, you'll start to see that as well. So, how does this market symmetry strategy work? Well, this strategy, this trading strategy, it's built on several key components, and they all sort of work together to give you the tools that you need to sort of make informed decisions and make proper entries for trade. So the first main point here is that this strategy works where you buy, so your entry levels are at support, and you also buy when there's been a back test after a breakout. So the core strategy is buy at support levels and sell at resistance, or buy when a back test after a breakout. So basically, when you look at a bunch of charts and you study them, you'll notice that there are sometimes these breakouts where there's these bullish engulfing candles. So it's a green candle that's gone up through some levels of resistance. So some resistance levels that potentially were support in the past, whether they be things on technical indicators, moving averages, and whatnot. And when a bullish engulfing candle breaks through, and then in several days later, or maybe several weeks later, it comes back and back tests it. So the price goes up and it comes back and touches those levels and turns resistance into support. That is a good entry position. That is when you would want to buy when there's been a breakout and a backtest, or if a stock is falling into a strong support area. So that's when you enter the trade where price has proven to be a support level in the past. And these strong levels are where demand tends to push prices back up. So the key point with this strategy is, only buy at support. When do you buy? You just buy at support. And support levels are levels that you can analyze on the chart through your technical tools and your chart reading ability, or when there's been a breakout and a back test. So as easy as it sounds, those are the rules. But once you get trading, and in the next podcast episode, I'm going to talk about my experiences. Rules are your trading strategy should be followed, but it's very, very hard to do when you see things breaking out. You get FOMO and this and that. Buying at support only seems like a simple rule, but it's very hard to do. And I think that's what really separates winners and losers, being able to follow their strategy. So that's the key main component of this strategy. Now, the other thing is to sort of dollar cost average in a bull market. So the market that we're in now, it's a bull market. And basically what you would want to do is you'd want a dollar cost average up or down around support level. So when the price drops after your initial entry, so say you buy at support with this strategy, but the price goes down, you can consider buying at lower support levels. So your entry on a trade in using this strategy, you'd never want to hold a position greater than 10% of your portfolio. But when you initially enter a trade, based on your conviction of that support level should be how much you allocate to that position. So if it's a very volatile market, volatile stock, or if you don't have a strong conviction that a particular support level might hold, then you'd want to lower your allocation, thinking that potentially price will drop down to the next support level where you'd want to dollar cost average in. So part of this strategy is really getting in when prices retrace to support levels to get the best price before the stock moves back up. And this is recommended to do in bull markets only. So if we enter a bear market, then I'll do an update of how this strategy might change. But again, this strategy emphasizes dollar cost averaging in these bull markets where prices are generally trending up. So you want to buy a stock that is trending up. It's making higher lows, higher highs. And these support levels would generally hold, but if they don't, then you can potentially wait it out until your position changes, or if there's further support levels where you can buy in as well. So in terms of timing, you can kind of see if you've been trying to visualize this, these types of trades generally work well with swing trades or even longer trades. So you might buy support and it might be stuck there for a couple of days or maybe a couple of weeks before it actually breaks back out. You can do this type of trading on a lower time frame. So you can look at a daily chart or even a 4-hour chart and do the same thing. So when price retraces back to support levels on these lower time frames, you can day trade with this strategy. However, the way I've been studying it, it's more of a swing type of trading strategy. Now, the other point here is to be very patient and to avoid over trading. So patience is really crucial for this strategy. There might be days where you don't make any trades. You don't want to force any trades. You don't want to chase any sort of prices. You want the price to come to you. So if you can recognize a support level on a chart, you can put in an alert, and when price retraces back to that support level, that is your entry. If you see a chart and you've missed out and there's a breakout, you don't want to buy, you don't want to chase, you want price to come to you. This is difficult to do as a beginner. You really, really need patience, and you really need to understand that there are so many opportunities out there. And if you miss one, it's no big deal. Another one will come your way. So sticking to this, being very disciplined is really, really important for the strategy. But I understand, if you're listening to that, you might think, okay, that sounds easy. It's actually not. Once you're trading, especially if you trade real money, it can be very difficult to stay patient and not overtrade. Many beginners overtrade, they chase, and it can lead to you losing money. The other point is to have confluence between log and linear charts. So you would want to look at a linear chart to find out support levels. You can also look at the log chart, and then you will want to look between various technical indicators to get confluence. So again, confluence is when you notice a support level, and then you also notice that using a different type of chart, a different time frame, and different technical indicators as well. And then you have to be comfortable with discomfort. The key mental component of this strategy is learning actually to be comfortable buying when it does feel bad. So when price is dropping to support levels, as a beginner and you're watching that, it's generally going to be hard for you to buy when price is falling down into a support level. You might not trust that position is going to hold, but you need to trust the system. You need to paper trade and practice and focus on, the trusting that the market structure is still bullish for your charts and that these support levels will hold. And if they don't, then you can dollar cost average into lower support levels. So it's going to be uncomfortable, but that's the opportunity for the strategy. And for many strategies, I think a lot of beginners, they buy when the price is up, all-time highs. That feels good, but that's not when you want to buy, particularly not with this strategy. You want to buy when price is down in a support level. And generally that does not feel comfortable, especially when you were just getting started. In terms of profits, I mentioned that you sell at resistance. So it's going to depend what you want to do. You can meet that resistance on a day-to-day basis and do more day trading, or you can look for targets that are further out and kind of wait and just ride the momentum of some of your trades. So that would be more of swing trading or position trading, where you buy at a support level and it might not reach your resistance level for several weeks, and then you would potentially get out of a trade. So again, that's going to dictate, or whatever type of setup you do, it's just going to be based on what kind of trading you want to do with this strategy. So how do you actually find these support levels, these breakouts, and these backtests? Well, you do that with various technical indicators on your chart. So the four main ways, tools, and strategies to find support levels and breakouts are to use the Ichimoku clouds, Fibonacci retracement levels, Gann charts, and then market structures. So in the past, I've got some YouTube videos about these things. Certainly, you can go to YouTube, or you can go to our school group, and you can find some actual tutorials and modules on these, but you can just go to YouTube and sort of figure all of these out. But basically, the Ichimoku cloud is a good visual representation showing potential support and resistance levels. It has various components that offer support through a stock as it's rising or falling. So that's a technical indicator that you use for the strategy. And then you also want to get confluence with other things like Fibonacci levels. So for example, if price is retracing and there's a fib level at a certain price, and that also coincides with maybe the conversion line on an Ichimoku cloud, then you've got two levels of confluence that support potentially will hold. That could potentially be a good entry point. So you want to use confluence with these indicators. Gann charts is a big one for this strategy. I haven't spoken about Gann charts yet, but they are very, very useful in seeing the market symmetry of a stock and how it rises and falls. And some of these stocks follow these Gann charts extremely accurately. And you can just see the market symmetry when you use Gann charts. So in the future, we're going to have Gann chart tutorials on the YouTube channel. So certainly look out for that. Subscribe to the channel or come to our group on school. We're going to post any tutorials on Gann. So Gann charts is something that this strategy uses. They're actually really easy to use once you sort of know how to set them up, but they really highlight market symmetry. So, if you've got a Gann chart and prices, back testing, or it's approaching, a Gann arc or a Gann angle, then that's another point of confluence where price is going to potentially touch these lines and use them as support or use them as resistance. And then understanding overall market structure is really, really important. And this is why this strategy sometimes uses a high time frame. You want to look at a weekly chart or a monthly chart and just understand, is the chart bullish? Is it making higher lows and higher highs? Then it is a bull trend, and you can be confident in buying support because, it's not a bearish chart, it's a bullish chart, and, price will be moving back up and to the right. So combining all of these indicators is what you do to find these support levels and to research and find these breakout and back tests. So basically, that's what the strategy is in a nutshell. It's designed to really eliminate emotional trading by focusing on these predictable patterns, the symmetry that is found in all of these charts. And what you really need to practice is being patient, looking for support levels, letting price come to you, locating the support levels. And when price comes and hits those levels, then you do a buy. And if it doesn't, then you just move on. So it feels like it's a much more of a stress-free type of trading strategy. So you're not potentially, getting in and out of trades every day if you don't want to. You can sort of look for these patterns, set up alerts, and then buy at the support level. So sort of sounds easy. Certainly it's harder than it sounds because, you're going to get the various common mistakes that any traders encounter when you're doing any type of trading. But generally, that's what it is. You focus on these patterns, the symmetry. You have a lot of patience. You don't chase. And you dollar cost average into bull markets where you might want to accumulate a stock, or you might want to, just buy and sell if you want to day trade this strategy. And then you trust in the market structure and these technical indicators. And again, follow the strategy to a fault. Follow it and, don't sway from the rules associated with the strategy. So that's basically the strategy in a nutshell. I am trading with it. I am enjoying it. I am enjoying learning more about it and practicing it. In the next podcast episode, I'm going to actually talk about some of the rules that are associated with this strategy, and then some mistakes that you might encounter when you start trading with this strategy or with any strategy. And I'm going to talk about, how my experience was on Halloween trading, and some of the things that I've actually learned from that day where it was a downward day. I was trading a stock that was just falling through all sorts of support levels, and I ran into many of the common mistakes that traders do. And I'm really glad I did do that while I was paper trading, because sometimes when you hear a list of rules or you hear a list of mistakes, it takes you to actually experience them when you're actually trading for it to really sink in. And if you can do that when you're paper trading instead of risking real money, I think that's really, really important. And in next week's episode, we're going to talk about that experience. So I hope that you found this useful. Again, in the show notes, I'm going to have a link to a video that goes over this, and I'm going to have links to the actual resources that I'm using to study this strategy and trade with it. And again, it's not a day trading strategy per se, but just because you're looking to become a day trader doesn't mean that, swing trading or position trading might not be best for you. That being said, you can day trade with this if you wish, but generally it's used at more of a higher time frame chart, weekly charts, monthly charts. And generally, you're going to hold on to some of these positions for longer and build wealth with them, especially in the bull market that we are in right now. So thanks so much for listening. I hope that you found this useful. And again, all the information that's useful, I'll have in the show notes below. And in next week's episode, we're going to talk about my experience and some of the rules that I've been following and some of the common mistakes that I have been making, which you really need to learn and understand what they are. Maybe experiencing them yourself in your paper trading account, because they can certainly do a lot of damage to your portfolio if you run into them. So thanks so much for listening, and I will talk with you in the next episode.